Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're back in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Pat Brown back on the podcast. Pat is an international tax partner in PwC's Washington National Tax Services practice, where he serves as the National Tax Office co-leader. Pat, welcome back to the podcast.
Always a pleasure, Doug. Thanks for having me back on.
Great to have you back on. You are still #1 in appearances. Pat, I just got back. I've been on the road internationally for almost 4 weeks. I had a few weeks home, spent some time in Asia, and then just got back from Europe, and a lot to talk about, particularly Pillar 2 and U.S. tax. But before we dive into the tax policy, as I travel around, I'm always humbled and thrilled to hear of the number of folks around the world that listen to the podcast. And they ask me about baseball, Pat. I would like to think that my podcast has done for baseball what Lee Shepard's articles have done for handbags. Because I certainly know a lot more about handbags.
Yes.
So Pat, who's your team in American baseball? We're about a third of the way through a 162-game season, which is hard for non-U.S. folks to wrap their heads around. Who's your team, and how are they doing this year?
So I am a Cincinnati Reds fan. I did not grow up in Cincinnati. My brother does live there now. But when I came of age as a baseball fan, as a very young boy, the Reds were, I think, probably the best team in baseball, certainly one of the best teams in baseball then. They were called the Big Red Machine. And I can still name for you every position player on those Cincinnati Reds teams from the mid-'70s, virtually all of whom are, I think, on the Hall of Fame now. So that's my team. And they are today, I believe, a game above 500, so they are relevant to the conversation. Which is great. I mean, they're a small market team, so sometimes it can, sometimes you get to the All-Star break and, you're almost kind of done for the season. And at least for the moment, it doesn't look like that for the Reds. So hopefully they'll keep performing well.
There is one notable exception from that particular team that is not in the Hall of Fame, but that could change.
But could change.
That could change.
We're talking about Pete Rose.
Maybe we'll have a separate podcast on the Pete Rose incident. Well, for those that aren't aware, the Reds are in the same division as my St. Louis Cardinals. We are, I think, we're certainly exceeding expectations. This was supposed to be a rebuilding year. The Chicago Cubs, however, are running away with the division. They are much better than I think people anticipated. But I'm just happy to be at this point of the season, and we're above 500. And there's always a shot with this new wild card. And
that's what you want.
Baseball is so long, all you want is just a little hope. Right? You just need some hope to keep you through the dog days of summer. And I think the Reds have some hope. I think the Cardinals have some hope. I mean, there's a few teams that are just really, really good, and then there's the rest, and I would put both of us in that category.
For sure.
All right, well, let's move on to some more mundane topics outside of baseball. And I want to start with the One Big Beautiful Bill Act. And I would like to remind listeners that is the actual statutory text name.
It is.
People have been referring to it as the OB3, which I think comes off the tongue better than the OBBB. So we'll just call it the OB3. We're recording this, it's June 12th. We are anticipating the Senate language for coming out very soon. So just want to remind listeners kind of where we are in the process. But maybe if you can remind, particularly for some of our non-U.S. listeners, how does this whole thing work? Where are we in the legislative process, and what can we anticipate? Because I know President Trump has said that he wants something on his desk by July 4th. And sort of just remind folks, how does this process work?
So to start with, I would say, for a lot of folks, this feels probably like it's moving very quickly, but actually the seeds for this were planted, frankly, several months ago. This is what we call a reconciliation bill. So A reconciliation bill essentially is a bill that is moved forward through the Congress pursuant to a budget act that was done, I believe, in 1974. And it brings with it a lot of procedural constraints. It's a big pain in the neck to do tax bills through reconciliation. It also brings with it one enormous benefit, and that is you do not require 60 votes in the Senate to move a reconciliation bill forward. So for most legislation under our system, in order to get out of the Senate, you need 60 senators to say, I support that piece of legislation and I'm prepared to move it forward. For reconciliation, you only need a bare majority. But under our system, the way a reconciliation bill works is both the House and the Senate agree to what is referred to as a budget. And a budget essentially is just a bunch of numbers that say how much each committee in each House of Congress agrees to either spend or how much they agree to raise as revenue. Reconciliation bills must have an effect on revenue. You cannot make policy changes through a reconciliation bill, so they must have an effect on revenue. Once the House and the Senate agree on a budget, which they must agree together jointly, they then turn to the exercise of writing legislation. The budget was agreed several months ago now. You then turn to the process of writing legislation. Under our system, all revenue generating measures must start in the House of Representatives. That's in the Constitution, so that's required. The House has taken essentially the mantle of the agreed upon budget, drafted a reconciliation bill that meets the requirements of the budget, passed it out of the House. This happened towards the end of May, right before our Memorial Day holiday. That legislation then comes over to the Senate. And again, under our system, for a bill to become law, it has to be passed by both the House and the Senate and then go to the President and have the President sign it. Both the House and the Senate must pass identical legislation. If there is literally any difference between the House version and the Senate version, it does not move forward to the President for his signature. And unlike our system, even though the House goes, unlike other systems rather, even though the House goes first, the Senate essentially has an equal bite at the apple. So the Senate could literally see what the House has done, tear it in two, write a completely new bill, and send that back to the House and say, you guys, essentially, we didn't like your bill, so we did our own completely new one. So that's how the process works at a high level. So, and again, because this is a reconciliation bill, it took shape months ago with an agreed upon budget between the House and the Senate. The House then is constitutionally required to go first, which they have done. The bill is now over at the Senate. To your point, you mentioned it earlier, Doug, we're probably going to see the text of what the Senate proposes to do, which we absolutely are quite clear already is going to be different than what the House did. Not completely different, but won't be identical, which means the process will proceed from here with the Senate presumably passing some version of a reconciliation bill that will differ from the House. And then the House has to decide, can we accept what the Senate has changed and just pass it essentially ourselves without further changes? Or will the House insist on further changes, in which case we could end up kind of in a back and forth between the House and the Senate. So that's the process at a high level.
Is it realistic that all of this will be done by July 4th? Or what happens if it's not? Because that was President Trump's mandate.
Yeah, so is it realistic? Yes. Is it likely? Probably not, but I would say it's not like crazy to think that they could. So the way that this gets to President Trump's desk by July 4th, there's really only, I think, one viable path. And this is, by the way, the way White House leadership, including the president, as well as Senate leadership, are talking about this. The way they are talking about this is, look, we, the Senate, will pass our version of the reconciliation bill during the month of June, before June ends. Before the bill passes the Senate, we will essentially have conversations with leadership on the House side, so Speaker Johnson and others on the House side, and at least endeavor to have the bill that finally passes the Senate be a bill that the House can just basically pick up and immediately pass without any further changes. In that scenario, Senate acts on the bill before the end of June. Bill goes back to the House. The House has already essentially signaled, at least at the leadership level, that they think they can move it through quickly without changes. They successfully do that, and then it goes to President Trump's desk for signature. That could all happen by the 4th of July. Again, we don't think that's the likely scenario. We think it likely slips into the month of July. But again, is it possible? Very possible. Now, I will note, Doug, the one big beautiful bill passed the House by one vote.
One vote.
One vote. And when the bill was sent over from the House to the Senate, essentially Speaker Johnson on the House side said, please don't make a lot of changes to this. Please make very, very modest changes to this because I'm not sure I can pass a bill back through if essentially the elements of compromise that we were able to forge in the House are meaningfully changed. Now, the Senate's going to test that because they're already talking about making some changes that get at some of the things that were part of that delicate compromise on the House side. So we'll see how it plays out from here. But anyway, the path to getting there by July 4th would be the Senate passes something the House can immediately take up and pass without further amendment, and then you get to President Trump. Under what I'll call more realistic scenarios, this process, maybe the Senate acts before the end of June, but what passes the Senate is not something that can clearly just be taken up by the House. So then essentially Speaker Johnson has to sit down along with perhaps President Trump and say to the various factions within the House, we really need you guys to get on board. Maybe, in fact, the House ultimately does pass it without amendment, but that may take a little time to get people there. So those are some of the scenarios we're kind of looking at.
So I remember a time, Pat, not too far ago when there was a political party that had control of both chambers of Congress.
Yes.
Where the president was also of that same party.
Yes.
They were very confident that they were going to get a
Yes.
bill through, and it didn't. It didn't happen.
Yeah.
So and of course that was during the Biden administration.
Right.
The Build Back Better
Yes.
Act, where they were going to
Yes.
move GILTI to country by country, raise
Yes.
the corporate
Yes.
tax rate.
Yes.
What hypothetically, if they're not given the razor thin sort of majorities that they have, what happens if this thing does crater? And does that mean everybody's taxes are going up? Because we've talked about on the podcast before that this is really like individual rates will go up if they can't get a tax bill through.
Yeah. So, I mean, a couple of possibilities here, I think, Doug. One possibility is they sort of say, well, we tried Reconciliation Bill 1, that didn't work. Let's go back to the drawing board, do a new budget, try and do a second reconciliation bill. I'm not really sure why one would think that the second one would be more successful than the first one. You could, in fact, try and do some sort of a skinny down version of a reconciliation bill. So that's a possibility. Another possibility, which I would say is probably almost equally likely, is we get closer to the end of the year and the Republicans essentially have to go to the Democrats and say, we don't want all the individual taxes to go up next year. You don't want all the individual taxes to go up next year. So let's work together on a bipartisan basis. That, by the way, Doug, is one of the reasons why I think the odds of this reconciliation bill ultimately failing are very, very low. They're there, to be sure. It could fall apart. But part of the reason they're very low is the people who are most stridently insisting that if they don't get what they need, they won't vote for this bill. Most of those people ultimately will look in the mirror, I believe, and recognize that if they don't get this bill, they're not likely to get a better bill if the Republicans essentially have to turn to the Democrats and say, help. So to be sure, there are legitimate concerns that Republican members of Congress have. There's a lot of talk about debt and deficits. There's talk about the limitations on state and local taxes for individuals, on deductibility of state and local taxes for individuals. These are all, I think, I'm going to say kind of, sincere concerns that these members have. But ultimately, when it comes down to, am I going to take down a bill from where, that's being championed by a president from my own party, when taking down that bill very likely means what happens next is I have to go to the opposition party and work out a deal with them. And how likely do I think it is that I'm going to get a better deal out of that than the one I've got in front of me now? I'm sure many lawmakers who vote for this bill in the end will be incredibly frustrated because it won't reflect as much as what they want. But that's the legislative process.
That's the way any negotiation.
Right.
But Pat, you and I are both old enough to remember when tax bills used to actually be a bipartisan effort.
Yes.
I would like to see that at some point.
And to that point, Doug, part of the reason why the process right now makes for a lot of challenges for our clients in the business community is how much of a sense of stability do you have when provisions are passed into the law, when one party is in power across the House, the Senate, and the White House, and then the other party, as frankly happens pretty regularly in our system, they take control, very narrow margins, but have the House, the Senate, and the White House, and they use this same process to essentially try to undo what the prior party had done. And so this kind of pendulum swinging back and forth with respect to tax policy does make it harder to have certainty with respect to business planning decisions. And as you and I both know very well, what do businesses crave more than anything else in the tax area? It's certainty with respect to planning decisions. Nobody wants their taxes to go up, but they also want to have some certainty with respect to how they can plan.
So let's talk about some of those business provisions that are currently in the bill. And I think some of the ones that are the most important for U.S. taxpayers are temporary, right?
Yeah.
Because they need to meet these budget constraints.
Yeah.
And then I want to spend the balance of our time talking about 899 and what that means to Pillar 2, and knowing that some of these business provisions could change. But what are a handful or a few of the important business provisions for those operating in the U.S. and or U.S. MNCs?
Yeah, so certainly something that the House wanted to do and was very closely watched was deal with what we sometimes refer to as the TCJA orphans. So these are provisions that were enacted in 2017 as part of the Tax Cuts and Jobs Act, but because of the constraints of reconciliation legislation, they essentially sunsetted or expired or had to be revised. And the big three there were the deductibility of research expense under Section 174. So beginning in 2022, research expense had to be capitalized and amortized, 5 years for domestic expense, 15 years for non-U.S. expense. One of our interest expense limitations, Section 163J, previously had been done on a 30% of EBITDA basis. Starting in 2022, becomes 30% of EBIT. So essentially a more restrictive computation, making the deductibility of interest more difficult, more challenging for a number of taxpayers. And then lastly, so-called expensing or bonus depreciation. So these three provisions all moved to a less favorable profile a couple of years ago. Congress has been very clear that they wanted to restore these provisions to what they had originally adopted in TCJA. Now, having said that, they don't quite get there in this bill for two reasons. One is these provisions are done on a temporary basis.
Yeah.
And again, that's because it's cheaper to do it on a temporary basis if you look at the math of budget reconciliation.
Until 2028 and 2029, depending on the provisions.
Correct. Now, the other thing to remember, though, is Section 174, the House-passed bill would restore the deductibility of domestic research, but would not restore the deductibility of non-U.S. research. And so for taxpayers looking at that issue and concerned about that issue, that remains an issue that they're talking to folks on the Senate side about. The problem with these provisions is doing them on a permanent basis, which is what the Senate is talking about. They're really wanting to do, wanting to have these provisions operated on a permanent basis. Permanent, at least nominally permanent, makes it a lot easier for businesses to plan. That's a good thing, very good thing. And that's why folks on the Senate side are pushing so hard for it. It is a lot more expensive.
Right.
And the one thing that you must do in a reconciliation bill is you must make the numbers tie back to the budget that was previously agreed. And inevitably, in a reconciliation bill, usually on the Senate side, there comes a point where the senators look at all the things they want to do, and they look at the math of the budget reconciliation exercise, and things have to fall away. Right. Things have to get stripped out, or have sunsets, or other things like that. So one of the things we'll be watching closely as we see what the Senate does with this bill is, what do they do with these TCJA orphan provisions? Apart from that, Doug, on the business side, honestly, the House-passed bill, it does a couple of things that are really important. One of them is it largely extends, largely with a little asterisk there, because they slightly notch up the rate on the GILTI provisions, the FDII provisions, and the BEAT provisions, but they essentially largely extend them very close to their current rate with basically no change. That was, I think, for a lot of folks in the business community, a win. It wasn't a huge win in the sense that they would have loved to have seen some more taxpayer favorable changes, whether to the GILTI regime, FDII, or BEAT. But the fact that they essentially provide this permanence, keeping the rates where they are for those three provisions, where they were supposed to go up next year, meaningfully go up next year, as opposed to this slight notch up that they got in this bill. So basically keeping them very close to where they are right now and doing that on a permanent basis so that they don't have to be revisited in the future was a big win. But again, to the extent people were hoping for, we'd like to see more done to the international space, relief and expense allocation, more generous provisions for FDII. The House bill doesn't do anything like that. So a big question hanging over the Senate's exercise is to what extent the Senate will take that on.
Yeah, and I'm interested to see, like, particularly with respect to the orphan provisions that you described, whether they may look at GILTI or FDII as levers they can turn to potentially make those other provisions permanent. Just one point on GILTI, because I was a little confused as to why they ratcheted up such a tiny portion, and I think you mentioned it earlier in the podcast. It has to be revenue raising.
Yes.
Right, and so they needed to at least ratchet it up a little bit so that it could meet these procedural requirements in the reconciliation bill.
Yes, exactly right, Doug.
I do wonder, and we will have a subsequent podcast of this after we get the Senate bill, if the Senate may be willing to increase GILTI as insofar as a way to potentially appease the OECD if they're looking for GILTI to become a qualifying IAR. We're going to come back to that. That's a dial that could be turned potentially for two reasons. One, to get additional revenue. One, maybe to get the OECD comfortable. Who knows what's going to happen with that. But I would like to move now to what has been taking a tremendous amount of our time as we've been talking to affected and potentially affected taxpayers is Section 899.
Right.
We talked about on prior podcast 891. We're not going to revisit that. But 899 is based on a couple of prior proposals. But maybe if you can remind listeners, or really I think we can start from scratch because there are some fundamental changes. What is 899? And also, Pat, I will tell you, never in my career as I travel around the globe, non-U.S. folks are asking me about a particular code section. Like here we are, tell me about Section 891. I was taught, don't talk into code, don't mention, don't talk in code sections, don't talk in code section. Everybody in the world. I mean, it was mentioned in the Financial Times. It was mentioned in The Economist. What is Section 899?
So Section 899 is a provision that was in the House passed bill. So it is in the bill that came over from the House and is now sitting before the Senate. And, it essentially, from House Republicans' perspective, it scratches an itch that they have been itching to get after for some time. And that is, there are concerns about really two main forms of taxation that the United States Congress, on a bipartisan basis to be sure, but much more vocally on the Republican side have been concerned about. One is the Pillar 2 UTPR. The undertaxed profits rule of Pillar 2. A second very important issue, and probably even more clearly bipartisan, is U.S. concerns about digital services taxes, or DSTs. Prior versions of Section 899, so Section 899 was first introduced by Chairman Smith in a different form 2 years ago. Reintroduced in January of this year in a different form again, and then this version that has just passed the House is, again, somewhat different than the two prior versions that came before it. So Section 899, this version of it, the one that just passed the House, for the first time, says out loud, says specifically in the text of the bill, you know what we don't like? We don't like the UTPR. We don't like digital services taxes. Those are so-called unfair foreign taxes. Now, the bill also names diverted profits taxes. That's a much, frankly, less impactful category because we're talking about one or two countries that potentially have those. So the focus appropriately is really on the Pillar 2 UTPR and digital services taxes. And what Section 899 does are really two different mechanisms. Now, each of these mechanisms you kind of have to unpack a little bit, but there are two different mechanisms that the House passed bill uses to express displeasure with the UTPR and with digital services taxes. The first thing that it does, and this was in Chairman Smith's original bill, is it says we're going to ratchet up U.S. tax on payments that are subject to U.S. tax by 5 percentage points each year that a country has in place one of these unfair foreign taxes, one or more of these unfair foreign taxes.
So both individuals and corporations located in those jurisdictions that have imposed unfair taxes.
You got it. So if you are, simple example, Doug, you are an individual residing in the UK, which has a digital services tax and has the UTPR, and you own stock in a US company from which you receive dividends. That individual residing in the UK would face an increase in the amount of US withholding tax they would pay on those dividends. Similarly, if you're a UK corporation with a US subsidiary or a US branch. Those two things don't get exactly the same treatment, but they both face increased taxation. So for the UK subsidiary the UK parent with the US sub, the US sub itself is a US corporation. It's not a UK, it's not a foreign person, it's a US person. So the US subsidiary does not directly face increased taxation. However, payments of interest from the US sub to the UK parent would be subject to increased tax. Dividends would be subject to increased tax. Royalties would be subject to increased tax. If the UK corporation operates in the US through a branch, so that's a UK person with US effectively connected income, the rate of tax on the branch's income would go up directly by 5 percentage points each year that this provision is in effect. Now, the way Section 899 works, this portion of Section 899 works, it's written so that there's a cap on the amount of increase. The cap is 20 percentage points, but there's a caveat to that. And the caveat is, if you are a resident of a treaty jurisdiction, and today you're eligible, for example, to receive income from U.S. sources on which you get free of withholding tax, so 0% rate of withholding tax on that income. The way the bill is written, the tax increases by 5 percentage points each year. So you go from 0% to 5% in the first year, but it keeps going up all the way up to 20 percentage points above the statutory rate without regard to the treaty. So quite literally, the tax could be as high as the withholding tax could be as high as 50% on that income. Now, it would take a long time to get there, but that is essentially the way that mechanism of Section 899 works. It says, if you are a resident of one of these countries that has unfair foreign taxes, we're going to increase the tax imposed on you that we, the United States, can increase by 5 percentage points each year as long as these unfair foreign taxes remain in place. There's a lot of focus and attention on that. What's gotten a little bit less attention, but as you and I know, Doug, in conversations with companies, they're now waking up to the fact that Section 899 also makes changes to the U.S. BEAT regime.
So before we go there, let me just, this is a question that I've gotten a number of times, and it's, I'll warn you, this is a loaded question. Does the U.S. Congress have the ability to be able to amend the terms of a double tax treaty?
Yeah. So under our system constitutionally, absolutely, they do. It is very clear that under the U.S. system, treaties and statutes have equal force of law, and so we sometimes refer to this, Doug, as a later in time system, right? So if a treaty is on the books, Congress passes a statute that essentially operates in derogation of the treaty provisions. That statute has force of law over the treaty. The statute overrides the treaty. It's a more complicated question to answer than simply that, though, because judges interpreting statutory provisions generally will adopt the view that a treaty override, a statutory override of a treaty, is not to be inferred. So judges will not typically assume that Congress intended to override a treaty unless Congress sends some sort of a signal to say, we're changing the law and we intend for this change of law to override the treaty. Now, that can be explicit in the statutory text for reasons that I won't torture everybody with. You cannot override explicitly in a reconciliation bill. The Senate can do, or the Congress can do it in other legislation, but in a reconciliation bill, they cannot explicitly override a treaty. And so the approach that the House-passed version of Section 899 does is they don't explicitly mention treaties by name, so they don't explicitly override a treaty, but both the structure of the provision as well as the House committee report describing the provision make it clear that the intent of Congress is to override tax treaties. So it is clear, I would say, is it 100% clear? No. Is it relatively clear as we sit here today that the House-passed version of 899 would be a treaty override?
Yeah, and from the language in the House bill, it seemed that was obviously very much considered, and yes. I think you highlighted those points that was carefully considered. All right.
Yeah.
So let's move on to the super beat, because this 5% additional tax on pretty much all taxes, I will also note that it does not apply to dual residents, right? Like there were some other changes from 891, but I know that was a concern for a number of folks.
Right.
So, but the one provision I feel like that's gotten a little bit lost because it's a lot harder to explain kind of what are base erosion anti-abuse taxes, what this so-called super beat.
Yes.
So maybe start briefly with what is the beat?
What is the beat?
What is the beat? And then, and I've got a number of podcasts if people want to go back and listen. And Nate Asher's done an amazing job on some prior podcasts going through this when this came in during the TCJA. But maybe briefly, what is the beat and why is this 899 provision so impactful? Because it could potentially subject so many additional taxpayers to it.
Yeah. So the BEAT, base erosion and anti-abuse tax, as you noted, was adopted in 2017 by the Congress. Last time Republicans had unified control and passed the Tax Cuts and Jobs Act. The BEAT is one of the most, I would say, inscrutable provisions of the Tax Cuts and Jobs Act. It's very unclear exactly what the BEAT is intended to target. But mechanically, the way it operates, Doug, is it is a form of minimum tax. The United States seems to have a love affair with minimum taxes. Our GILTI is a minimum tax, the BEAT is a minimum tax, we have the CAMT, another version of a minimum tax.
Almost like an undertaxed payment rule.
Exactly, in some respects, yes. So literally what taxpayers are required to do under the BEAT is compute your taxes twice. You compute your taxes under the regular tax rules, and then you recompute your taxes on a different base and at a lower rate, right? And that is the way the BEAT operates. So for folks who are familiar with the alternative minimum tax, whether on the individual side or the corporate side, at least to that point, it's a very similar concept. Do your taxes a first time, see what the number is. Do your taxes a second time. If you end up with a higher number, when you recompute your tax under the BEAT provisions, you're required to pay that higher number to the Treasury Department. And so that is mechanically how the BEAT operates. Now, what the BEAT targets on its face, you would think base erosion, anti-abuse tax, that sounds like they're targeting base erosion. And in part, the BEAT does. So the BEAT, at least as an initial matter, when you're kind of sketching out how to apply the BEAT and whether or not you're subject to the BEAT, you look at your so-called base eroding payments. So these are deductible payments from the US to a related foreign person. That's the starting point for the BEAT. One of the challenges with the BEAT, however, is as you go through the computation, things like, to what extent are you claiming tax credits in the United States? Which, by the way, could include foreign tax credits you're claiming in the United States. These are things that can all push you into the BEAT. And so for a lot of taxpayers, as they sort of initially assess the likely impact of the BEAT, they say, well, I don't have a lot of base eroding payments, deductible payments to related foreign persons. But then as they go through and do the analysis, they discover, well, actually, they maybe are subject to the BEAT. Because of the, frankly, kind of wacky way that the computation works and some of the results it can drive.
And what is that revenue threshold for those who are even subject to the BEAT?
Yeah, so is it $500 million? Yeah. Now, but you point out threshold, Doug, and that's a really important point because there are several thresholds that are built into the BEAT. One is the threshold of size at which you have to be subject to it. Another is the percentage of base eroding payments that you are required to have. So this is essentially the percentage of your total deductible payments that are made to related foreign persons. Right now, that percentage for most companies is 3%. For financials, it's a lower 2% threshold, but for most companies, that percentage is 3%. That 3% threshold, along with the $500 million threshold, they're both really important for a lot of taxpayers because the way those taxpayers manage the BEAT is keeping themselves below the threshold, right? And so if you
they're just below the threshold.
Well, right, or exactly. Maybe they're naturally below the threshold. But for a lot of taxpayers that we work with a lot, they sized up their deductible payments as a percentage of total deductions, and I'm at 3.2%. And when I do the math of the BEAT, because it's a weird, wacky calculation, I end up with a significant BEAT liability. Well, so then you get taxpayers asking the question, can I restructure things so that my base eroding payments drop below 3%, including, by the way, one of the things that the IRS has explicitly blessed is just walking away from deductions.
Yeah.
Right? If I want to say, hey, I'm entitled to a deduction for this, but I'm not going to take it, and by walking away from that deduction, I'm below 3%, I'm okay. One of the big changes that the enhanced BEAT provisions in Section 899 would do is strip away the protection of those thresholds. That's a big deal.
A huge deal.
And it's going to have a lot of effect on a lot of companies who up to now have been, maybe by the skin of their teeth, but they've been managing to stay below one of those thresholds and therefore keep
Well, and then there are a lot of just even smaller taxpayers that hadn't even focused or know what the beat is, that have operations in the U.S., and all of a sudden they are all now subject to this.
Right. There are other provisions of that in Section 899 that make the beat more onerous, including there's a big exception in the beat right now for payments for what we call routine services. They're just not considered, I'll call them beatable payments. They're not considered base eroding payments. Section 899 says, well, you're going to consider them base eroding payments if you are subject to these enhanced beat provisions. So there are a number of these provisions in there. Another one, Doug, is cost of goods sold, generally speaking, not technically a deduction, right? And so therefore not technically a beatable payment. Section 899 would say, we're going to expand the reach of the category of beatable payments to pull in a lot of those payments, not everything, but pull in a lot of payments that are right now treated as cost of goods sold and therefore outside of the scope of the beat. So Section 899 will make the beat operate in a much more far-reaching way for many, many, many taxpayers. And so it clearly is a point of significant concern for a lot of folks as they size up how 899 may affect.
Yeah, and I'll be interested to see with the Senate version if they maybe put back some of those thresholds. Just to not necessarily swallow all of the smaller investment. Who knows what could happen? But there's certainly been a lot of noise in the system as a result of this super beat provision. Again, I just don't think it's gotten enough press, particularly in the financial press. Certainly, it's gotten some in the tax press because it's a lot more complicated. But I would caution our listeners that have inbound investment into the U.S. to model that. And if you are not familiar with the beat, understand whether because your beat tax liability has to exceed your U.S. tax liability and start to do some of that modeling. Applicability dates for this, and there are a lot of sort of complexities in that the withholding taxes are generally prorated. Beat is not sort of once it's applicable, but when generally would these rules apply if a country has an unfair tax?
So the simple answer is 2026, January 1st, 2026. And obviously, to your point, you're going to have taxable year issues that can affect different taxpayers in different ways, but 2026. Now, to your point, Doug, that has gotten a lot of attention as well. Because one of the things that's been very clear from public statements made by folks in the Treasury Department as well as folks in the House of Representatives is we want this provision to be included because we want to see a change in behavior on the part of foreign governments. We're not doing this to raise revenue as such. In fact, what we're doing is we're trying to protect U.S. sovereignty, trying to protect the U.S. tax base, and using this as a mechanism to induce countries to change laws that they've already enacted and frankly deter other countries from adopting similar laws. And so if you think about where we sit today in the middle of June, there's not a whole lot of time to come to an agreement as to what exactly other countries would need to do to mollify the United States and then get their laws changed. You know, I am often reminded, you mentioned you've been traveling outside the United States. A lot of countries, they don't even necessarily legislate on tax issues every single year. Right? And if they do it, it may be at a particular point each year when they do it, and otherwise, they simply don't. So will there be a move on the part of the Senate to build more time into it? There's been a lot of speculation about that. Maybe push the effective date out a little bit, or build in more flexibility so that Treasury has an ability to push the effective date out. One of the things that I will note, and it's sort of almost a footnote, but it's, I think, an important one. One of the things that, because we talked about how reconciliation bills must affect revenue, one of the things that Section 899 cannot do, if it's going to be included in a reconciliation bill, is be wholly discretionary on the part of the Treasury Department. So if somebody says, look, why don't we just have this as a tool that's available for Treasury to use if negotiations aren't going well? Well, theoretically, that sounds like it could be a sensible way to proceed. But that couldn't go into a reconciliation bill because if you have a provision that is wholly discretionary, the Joint Committee on Taxation, which is the scorekeeper for all tax provisions in a reconciliation bill, would say, I don't know if Treasury is going to exercise that discretion or not. So this provision as written raises zero. Once it raises zero, it's no longer eligible to be in a reconciliation bill.
So this bill as written, non-discretionary, the revenue estimates were $116 billion.
Yeah.
It was one of the big ones.
Which, to contextualize, is a big number in the international space. It's rare to see numbers that size. Yeah.
I haven't studied this overly carefully, but I saw the chart, and they only provide so much information, but it raised revenue in the first, I think it was 6 or 7 years, and then in the back 3 years, it actually had a negative revenue impact.
Yeah.
Any thoughts on that and why that is, why there would be a negative revenue impact from a provision intended to raise revenue?
So we're really going to go deep into the weeds now, Doug.
Okay.
So I hope the listeners can bear with us on this. So I mentioned that the Joint Committee on Taxation is the official scorekeeper for Congress. Joint Committee is made up of staffers. These are not elected members of Congress. These are staff people. They have incredible expertise in essentially assessing likely impacts on federal government receipts. But they also operate under some constraints. One of the constraints that Joint Committee typically operates under, and I want to emphasize, Doug, I haven't had any conversations with Joint Committee about the revenue estimate for this particular provision, but I have had lots of conversations with Joint Committee revenue estimators over the years, and I have a pretty clear understanding of how they generally operate with respect to scoring provisions. As a general matter, Joint Committee on Taxation will not assume in a revenue estimate changes in foreign law. So as the Joint Committee does a revenue estimate for a provision like this one, which essentially, again, members of Congress who support it have said, we are putting this provision in to induce foreign governments to change their laws. So the purpose behind the provision is to get foreign laws to change. Joint Committee reacts to that and says, we cannot assume any change in foreign law when we do our revenue estimate. So Joint Committee's revenue estimate, therefore, is going to be built on the back of the impact of taxpayers, assuming no foreign law changes. So as you and I talked about earlier, Doug, in scenarios where the rate today of withholding tax on a payment is 0 because of a treaty, and foreign law doesn't change, the impact of Section 899 keeps going up all the way up to 50%, right? If no foreign law changes, that will be the result. Although, again, I don't have sort of inside details to talk about here. What Joint Committee almost certainly must be assuming, therefore, in this revenue estimate is not foreign law behavior, but rather taxpayer behavior. So taxpayers are changing the way they make investments into the United States as a result of these dramatically increased rates of tax. If you assume no foreign law changes, U.S. taxes keep going up and up. Again, depending on the facts, it may be 20 percentage points. It could be as high as 50 percentage points. And under those assumptions, Joint Committee puts together a revenue estimate. So the revenue estimate looks the way it looks, probably in large part because of the constraints that Joint Committee applies. But it also raises interesting questions because, of course, in a reconciliation bill, you have to get the numbers to work. The numbers don't have to balance out on every single provision. The bill in total, the numbers have to tie to the budget. And Section 899 creates, as the revenue estimate is currently done, creates this weird dynamic, whereas you raise a lot of revenue, and then you get to the back end and you're actually losing revenue, which can put pressure on the revenue analysis when you get to the back end of the bill. So lots of things to think about there in the revenue estimate. One of the things that I think is most fascinating about that is the revenue estimate is probably pretty divorced from what everyone agrees is probably likely to happen.
Exactly.
Which is at least some amount of change on the part of foreign governments.
All right, so let's then move to that change. That was a fantastic explanation, by the way. So 899, we've got the retaliatory, the U.S. is sort of locked, almost loaded, ready to go on this. What does the U.S. want specifically with respect to the UTPR? I think we know that they want DSTs, these digital service taxes and digital profits taxes.
Right.
But 899 was very specific in saying it doesn't want these other U.S. government or these non-U.S. governments to repeal UTPR.
That's right.
They don't want if the UTPR applies to the U.S. parents' tax base and foreign subsidiaries greater than 50% controlled of U.S. companies. They want the UTPR turned off to the parent as well as other subsidiaries. So maybe talk about like what out like from a overall negotiating position, and then the EU has also publicly said that they're not going to be negotiating with the U.S. on Pillar 2. They are going to defer to the OECD, although we all certainly know that the EU plays a very big role in what the OECD is going to be negotiating. But so I want to start with, what does the U.S. want, and what have we heard? Because this has kind of been out in the public too.
It has.
And where Treasury has explained, and then the EU has made some comments, and the OECD has made some comments. So maybe explain where we are at this point here in June.
Yeah, so to your point, Doug, Treasury's been really quite vocal, and now, in many public fora about what their position is.
Yeah.
And their position, they've been very clear, is not to repeal the UTPR, eliminate it. Although they would accept that. If a country has the UTPR and they decide to repeal it, okay, that's fine. But they've also said, look, our starting point, this is Treasury now, our starting point is we don't believe that the income that is within taxing jurisdiction of the United States is income of a type that is susceptible to base erosion. Our rules are sufficiently robust, and therefore income that is within the U.S. tax net is not income that other countries should be concerned about from a base erosion perspective. And that statement really is what drives Treasury's primary negotiating position, which you just articulated, which is income that is subject to United States tax, either as income of a U.S. person or subject to U.S. tax because it's taxed under our GILTI regime. That income should not be within scope of the UTPR. The UTPR is a backstop to make sure there's a minimum level of tax paid. Treasury's position is, hey, the U.S. rules tick that box. So there's an acceptable level of tax paid. Maybe the computation's a little different under our system than under the Pillar 2 rules, but that doesn't really matter. So the income of U.S. persons subject to U.S. tax should not be subject to the UTPR, and the foreign affiliates of U.S. persons should not be subject to the foreign subsidiaries of U.S. that are taxed under the GILTI regime should not be subject to the U.S. To the UTPR. So that's really the starting point for Treasury's primary negotiating position with respect to the UTPR.
And the U.S. Treasury has also mentioned some other provisions that they are focused on. One I don't want to dive too into is just about the ordering rules with QDMTT and GILTI coming before, but I think they've said they want more of that to be optional and still, but nothing in 899 would impact that. I think the bigger one that's much more impactful to taxpayers is the non-refundable credits. And the U.S. R&D credit. Maybe talk a little bit about that, and then I'm also very interested that, with some of the other provisions that we didn't talk about in the OB3 relate to changes in a number of the Inflation Reduction Act credits, and some of them that are marketable, where we have these marketable transferable tax credits, and they don't become marketable. And maybe before I let you go, it was fascinating to me, and Pat, we've talked about this, and I think we've talked about this on the podcast, that there are a lot of big inbound companies that have invested in the U.S., and in 2024, the number of those countries had income inclusion rules. And that R&D credit, because it's non-refundable, is effectively a bad tax for Pillar 2 purposes. And I will remind listeners, we are in June of 2025. I mean, that is behind us. And so the U.S. sort of was able to protect the base for U.S. MNCs by getting the full UTPR safe harbor. But that R&D credit is still exposed for 2024 for those countries that are located in a jurisdiction that have an IR that are invested in the U.S. And so what is the U.S. looking for on these non-refundable, at least what's been publicly said? And like, are they going to try to make this retroactive back to 2024?
So the whole credit conversation it's really been fraught from the very beginning of the release of the model rules for Pillar 2, because initially what Pillar 2 did, and again, this is ancient history and well understood by most folks, but just to very quickly summarize, the model rules as originally released by the OECD made a sharp distinction between refundable tax credits and all other forms of credits. And to your point, Doug, refundable tax credits essentially were just treated as additional income to the taxpayer, which meant that they could have an impact under your Pillar 2 computation, but that was going to be very muted, very minor, maybe at the margins, not likely to have an impact. Those were good credits. All other credits were treated as bad credits, including virtually every United States tax credit, because at the time, this was before our Inflation Reduction Act, we didn't have anything that looked like much of anything that looked like a refundable credit. And we weren't even talking about marketable transferable credits as a concept at the time. So basically, most U.S. almost all U.S. credits to speak of, including importantly the U.S. R&D credit, were just bad credits, which meant that to the extent you were doing too much research in the United States, you risked falling below 15% in the United States and being subject to top-up tax in some form under the OECD rules. That almost immediately got the attention of U.S. lawmakers, almost immediately, as a point of friction. In fact, when lawmakers talk about one of their biggest concerns with the UTPR, they will very quickly go to the impact on the U.S. on taxpayers claiming the U.S. R&D credit. So it has been a flashpoint almost from the day the model rules were released. Now, along the way, as we talked about earlier, the U.S. under Democratic control passed the Inflation Reduction Act, which included a huge increase in credits and incentives in what I'll call the green energy area. Some of those credits are, at least for some period of time, refundable. Many of them, by design, were transferable. So taxpayers could literally transfer the credit from one taxpayer to another, sell it.
Yeah.
Right? And this was intended to increase the market for these kinds of investments, to make it easier for taxpayers to make these kinds of investments. The OECD came out with administrative guidance revising the model rules effectively to say, we're going to treat transferable credits essentially like refundable credits. So on the good side of the ledger, right? Still no change to the treatment of the U.S. R&D credit. Still no change to that. But this marketable transferable credit was going to be treated as a preferred category. Now, what's happened since? Well, as you alluded to, Doug, the bill that just passed the House of Representatives would effectively turn off transferability now it would get rid of some others outright, but it would turn off transferability for a number of these categories of credits that were in the Inflation Reduction Act. Well, now, if they're no longer transferable, they're no longer marketable transferable, which means they're basically just regular credits. But still, even with that, the focus remains on the R&D credit. Mm-hmm. And so when members of Congress talk about what troubles them most, they very often very quickly turn to the R&D credit. Now, let's tie that back into Treasury's negotiating position. Treasury's negotiating position is also, as we understand it, hey, if a country has adopted the IIR and that foreign country has a U.S. subsidiary, that U.S. subsidiary should not be subject to the IIR either, because the income earned by the U.S. sub is within U.S. taxing jurisdiction. So even if it drops below 15% in the United States under the Pillar 2 computation, that should not be subject to any increase in tax. Now, to be clear, Doug, that concept, which is part of Treasury's negotiating position, is not reflected in the text of Section 899. Section 899 focuses on the UTPR. It does not talk about IIRs. It's very clear that IIRs do not constitute an unfair foreign tax under Section 899 as passed the House. So there is, I'm going to say, there's some convergence, but not complete uniformity between Treasury's negotiating position with respect to issues like the R&D credit and things like that, and the way Section 899 operates. Mm-hmm. Section 899 is more narrowly focused on the UTPR. Overhanging all of this, Doug, is the question of, and how are other countries going to react to Treasury's negotiating position? Under the waning days of the Biden administration, the Biden Treasury was in discussions, as we understand it, with other countries at the OECD to essentially come up with a more expansive treatment of favorable credits.
Exactly, just redefine sort of what, as opposed to this non-refundable, refundable, redefine what a good sort of tax credit is.
And that obviously is a challenging exercise because you tell me what's a good credit versus a bad credit, right? So the OECD, I think, perhaps somewhat naively, thought they could sidestep that whole discussion back in 2021 when they said, hey, it's refundable and everything else.
Above the line or below the line.
Right, exactly. It never seemed like that was going to hold. And I think where we are now is Treasury's negotiating position is essentially shining a spotlight on some of these issues around credits. Other countries had been in discussions with the Biden Treasury about maybe changing the treatment of credits. So what path forward do we take from here? How do we think about Treasury's current negotiating position? We know where we are on the UTPR. That seems very clear, and that's where Section 899 and Treasury's negotiating position are pretty much in lockstep. With respect to the treatment of the R&D credit and other types of credits in the context of IIRs, Treasury has a negotiating position. Where are we going to land with that? It's a fascinating thing. We'll all watch it play out together.
Yeah,
so.
And The other thing for listeners to keep in mind is, like, I mean, you and I love talking about this tax stuff, but there's, a lot of other elements to consider that we're not going to dive into. But what about the EU and the directive? 27 member states, and how to when as the U.S. is negotiating with the OECD, obviously EU is going to need to figure out what they can agree, if they agree to anything, to accommodate the U.S., and then how does that fit within the directive? It seems not very likely to me that the directive is going to get changed or repealed. They need all 27 member states to be able to do that. So whatever they do presumably needs to fit or be shoehorned within the existing directive. We, of course, have tariffs at play, where the Trump administration will be imposing a 50% tariff on the EU starting July 9th. That certainly factors in. So I'm not going to ask you to to prognosticate on where this may go, because none of us know. But maybe the last question for you: what do you recommend for taxpayers, whether it's U.S. multinationals, inbounds coming into the U.S.? What should they be doing in the short term? How do they try to make sense of this?
I mean, we are in challenging times. I would start with. Until the law changes, the law is the law. And that, I think, it's sort of an obvious fundamental point, but one can hope for maybe some changes with respect to certain aspects of Pillar 2, maybe some refinements to Section 899, if assuming it moves forward and ultimately passes, that will dial back some of its application in some respects. There's lots of things one needs to watch for and presumably hope for in this space in terms of making things somewhat more less onerous to deal with. But as a taxpayer, you don't have any choice but to apply the law that you see in front of you right now and figure out how to make sure you're in compliance with it. So I think that's probably the single biggest takeaway from all this. Watch this space, see what is happening with respect to potential changes, but recognize that, you said it, Doug, I think a really important point. The EU directive is not going to go away. We are still going to be facing a world where lots of countries have QDMTTs, lots of countries have some version of an IIR, and if you're globally engaged, you're going to have to kind of wrestle with these concepts in the Pillar 2 space. If you're a non-U.S. multinational with significant investments in the United States, you're going to have to wrestle with, to what extent is Treasury's negotiating position acceptable to other countries, and therefore they're willing to make the changes that Treasury is pushing for that would negate the application of Section 899. So we're going to have to be really good at looking in many places at once. Now, one thing that I will say, and this is maybe kind of a hopeful way to kind of summarize kind of where things may go in this space. Treasury, I think, has been very clear. U.S. Treasury has been very clear in their public statements. They are not insisting upon the elimination of Pillar 2, the elimination of the UTPR. They've also said, we're not suggesting that the EU directive needs to be changed. To your point, that seems like a really high bar.
Coexistence.
Right, exactly. This idea that, hey, we can coexist together, this can probably be managed through safe harbors at the OECD. Now, I think Treasury has left itself an out so that they don't essentially get trapped. They don't want to find themselves in a position in a few months' time that the EU says, well, we can't agree with that because that would require a change to the directive. Essentially, what Treasury has said is, we don't think these things would require changes to the directive, but we're not tying our hands to, and that I think again is just Treasury negotiating to make sure, but they clearly are presenting an approach that would allow this to move forward without changes to the directive. So it does suggest to me, Doug, we're far from home. It does suggest to me that there's a path here for dialing back or eliminating the impact of Section 899 and getting to a place where, for a lot of companies, the impact of 899 is kind of in the rearview mirror, something they don't have to worry about, and where the U.S. position kind of lines up with what the OECD and other countries think they can do. What effect that will have on credits and incentives, we'll have to see. So there's a lot to look for, but then there's the law today that we all have to deal with.
And I know you would agree with from a short-term practical perspective, particularly for those inbound investors, model the potential impacts of 899. If you don't understand the beat, spend some time with that. And then get involved with the process. In the U.S., I mean, we say this on all these podcasts that, And I think U.S. multinationals and U.S. taxpayers have maybe done that a little bit longer than, but I'm certainly seeing that outside the U.S.
Yes.
Educate those stakeholders, those policymakers to understand what those particular implications are. And then that's even more challenging in the EU because of the various, there's the country level stakeholders and EU level stakeholders. But I know you would agree to get involved in the process.
I couldn't agree more, Doug. And what's fascinating about the way 899 presents itself is there's U.S. legislation, so there's the opportunity to say, hey, I don't think that's working quite right. We need to think about changes to the U.S. legislation. There's also engagement outside the United States with foreign governments to say, essentially like, hey, I think they're really serious about this stuff in the U.S. They may be crazy, but they don't seem to be joking. So we need to think about what changes we would need to make to our laws. So we have to be looking lots of places at once, but I couldn't agree more, Doug. If there's ever a time to elevate your voice and make sure people understand how these provisions would affect you and what maybe could be done about it, the time is now.
So Pat, this has been one big, beautiful podcast. And we're going to come back. We'll see what happens with the Senate. Maybe we'll do part 2. And then if all this gets signed, part 3, and maybe a part 4 when the OECD changes. A lot more coming. But always a pleasure having you on. Insightful as always. Thank you very much.
Absolutely.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Pat Brown, PwC's Washington National Tax Services co-leader. I'm Doug McHoney, PwC's International Tax Services global leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.